Salesforce stock, here's the analysis. Guys, let's go to our software, 8 pillars, type in CRM. If you have a subscription to our software, follow along. If you don't have a subscription, everythingmoney.com, check it out. So here's the stock price, 52-week high of 311, right? And it's currently, it hit its low of 154, and it's currently at 171. So it's bounced off the low a little bit. So remember, guys, our goal is to evaluate the company based on what's behind that stock price, not just the stock price. So if you're watching this video and you're new, I'm Paul. I do these videos in Everything Money. I look at stocks as a piece of a business. So if that makes sense to you, please keep watching this video. So let's go through our 8-pillar process on stocks. First pillar, we want the 5-year PE ratio to be under 22.5. This is taking all of the earnings of the last 5 years, averaging it out, and then taking the current market cap, dividing into that. And we want it to be under 22.5. Guys, it's currently 118. So that already screams overpriced. All right. But does that mean the stock company is overpriced? I don't know. Guys, I thought CRM Salesforce was overpriced at $40 a share. It's now at 177. I looked really dumb when it was at 300 and something. I didn't expect the company to grow as much as it did, but we'll look into that shortly. Pillar number 2, we want the 5-year return on invested capital greater than 9%. So right here on our main page, we have it right here. It's only 5.4%. So another X right here. So it looks like they're not doing a great job of getting return on the money that's invested in the business. Now that could also be because they're investing a lot of that cash flow into growth. So just remember that. That could be the reason why. Pillar number 3, we want revenue growth over the previous 5 years. So we go to our income statement and we look at the top, scroll down a little bit, operating revenue, 10.54 to 26.49. Wow. 160% jump in a matter of 5 years. Pillar number 4, we want net income growth over the last 5 years. So very simply, we go to our net income line on the income statement, go back 5 years, 360 million. Last year, 1.44 billion. Check mark there. So far, we're 4 in, 2 X's, 2 checks. Pillar number 5. Now, pillar number 5 is we want to make sure that us as investors are not being diluted. How do we get diluted? When the company issues more shares. This is not to be confused with a stock split. A company can raise capital 2 different ways, debt and equity. When they raise money through equity, what they're doing is they're issuing more shares to investors, therefore diluting everybody who already existed as a shareholder. Now, you as a shareholder is splitting the revenue, profit, and cash flow, splitting it amongst more and more owners along with you, against your own will. That's not a good thing. So we scroll to the bottom of the net income of the income statement. At the very bottom, 6 years ago, the end of 6 years was the beginning of 5 years, 703 million shares, now 985 million. Guys, that's an increase of 50%. 50%. So if you had 1 share out of 10, you now own 1 share out of 15. You went from a 10% ownership to a 6.7% ownership in the company. Pillar number 6 has to do with long-term liabilities. Guys, companies are just like you and I. They're going to be more susceptible to higher debt levels, causing problems for them as time goes on. So how do we calculate this with the company? So we go back to the main page, our main metrics page, and we look at the 5-year average free cash flow. It's right here. Written right here, 3.6 billion. We multiply this by 5 and we get $18 billion. What I would like is the long-term liabilities of the company to be under 18 billion. Now I want to make note, remember that we thought because of the return on invested capital, there's a possibility that the free cash flow in the company is lower due to the fact that they're a growing company. So we'll see how this looks. So keep that in mind as you go forward. But we want currently the long-term liabilities to be under 18 billion. So what do? We go to the balance sheet, scroll all the way to the bottom, $15.3 billion. So that's a check right there. So they can pay off their liabilities in about 4.5 years. Not bad at all. And they're increasing their free cash flow as time goes on. So speaking of free cash flow, pillars 7 and 8 both have to do with free cash flow. Now, what is free cash flow? Free cash flow is cash from operations less your capital expenditures. Okay. You can do one of 5 things with free cash flow. You can buy back shares. You can pay down debt. You can invest back in yourself. You can issue dividends, or you can make acquisitions. You can do any combination of those 5. All, none, 1, 2, whatever you want to do. Okay. So we go to the cash flow statement here on our software. We scroll about halfway down, and since we want to make life easy for our software users, we added this free cash flow line where it does the math for you. 5 years ago, 2.2 billion. Last year, 5.3. Guys, look at this growth. 2.2, 2.8, 3.7, 4, 5.3. Nice, consistent growth. Okay, so that's a check mark there. And our final metric is similar to the PE ratio. We want to take their average of the last 5 years free cash flow, 3.6 billion, but right here, multiply it by 22.5. What do we get? 70 72 plus 7.2 is 80 plus a half, call it $82 billion. We want a market cap under $82 billion. All right? I really hope that math is right. Somebody out there watching, please verify me. So we go back to the main page, and the market cap is currently 168 billion. So that's a big X. We want it under 82 billion. So it's got to fall in about half. So for those of you who don't like the math overall, look at this. We've got all these on an 8-pillar page right here. And you'll see, oh, somebody sent me a message on our software. Not now. So we have a lot of X's here, but the biggest ones that matter to me are these 3. Those really bother me. I don't blame them for issuing shares because the company is so expensive. This is how the company acknowledges how expensive they are. They issue shares. Think about it. If you had a company that was being outrageously overpriced in the world, in the stock market, and you could raise debt from them by just giving them those shares, why wouldn't you? That's how they're proving that they believe they're overpriced. Because if they believe they're undervalued, they'd issue debt. Why would you give away important parts of really high returns in your company when you can issue debt at very low returns? The reason you do that is because you're overpriced. So does this mean we don't buy them? No. Remember, every investment's the present value of all future cash flow. So if cash flow is going to grow very, very rapidly, you should pay more money for it. Now, how rapid is it going to grow? Well, here's some analyst expectations on their earnings per share. They're expected to do $4.76 in the next year, which is a little bit of a drop from the year before. But look over the next 6-7 years. Now, guys, keep in mind, look at this with a grain of salt. These are analysts. Analysts have been proven over time to be very, very unreliable on long-term estimates for a company. 1 or 2 year basis, a lot closer. But as you go further and further out, these are harder and harder to gauge. Okay? So just keep that in mind. But it does show low to mid double digits growth for the next 5, 7, or 8 years. Let's look at revenue growth. This is the revenue growth. We're expected to do 31.8 and get all the way over triple in the next 9 years. All right. Again, big growth rates, mid-teens. So what do we do with that information? Well, guys, we have what's called the stock analyzer tool. This has been the most popular part of our software. Why is that? Well, it allows people to make assumptions about the future since the future is unknown. And this will tell you, without looking at the balance sheet, what you should pay for the company based on those assumptions. Now, does that mean if it comes out green, you go buy, if it comes out red, you avoid? No. If it comes out green or very close to it, go do more research. If it's nowhere close, go find another stock because there's probably not much that's going to make it get a lot better for you in the time being. You have to wait for the price to fall a little bit and the fundamentals to get a little bit better. So we're going to start by doing a 10-year analysis. You can do 1 through 20. Now, it's going to ask me for my assumptions, low, middle, and high for revenue growth, profit margin, free cash flow, PE, free cash flow, price of free cash flow, and desired return. Now, I'm going to use the 1, 5, and 10-year numbers to get a gauge. Now, in the last 10 years, they've annualized 27% revenue growth. We saw in the next 10 years, it was mid-teens. So let's go 8, 11, and 14. Profit margin. Now, I would imagine if you saw, I don't know if you saw, but on one of their years of profit, there was a huge jump in profit of $4 billion. So I'm going to pull that one out a little bit, but over long periods of time, profit margin and free cash flow should be pretty similar. So I'm going to be a little bit aggressive here. I'm going to go 8, 11, and 14. Sorry, 8, 12, and 16 here. Free cash flow, I'm going to do 17, 19, and 21. Now, PE. This is where all the haters are going to come out. Guys, I still look at the average PE in the market should be about 15 or 16. The faster the growing company, the better. But remember, we're looking at what this PE should be at the very end of 10 years after it's grown even more. So you want to go lower on the PE. So I'm going to go 14, 16, 18, and the same on price to free cash flow. And finally, guys, I pick a 12.5% return. Why? Because you can get 9 or 10% just by investing in ETFs. So give yourself a little bit of margin of safety and put in 12.5%. Okay. Now, if you don't feel comfortable with that because there's more unknowns than you like, go with a higher return. The higher the desired return, the lower the stock prices. So we hit the analyze button. And again, the company's currently at 170.95. Okay. The highest of highest assumptions says you should buy it. It's a green, or you should go do more research. The rest of them all say, hang on a second. Now, the great thing about this software we have, we can hit one of these plus marks. And I'm going to do that for 116.74. I'm going to say, hey, notify me when the stock hits 116.74 and goes below it. Why? Because this is showing like, listen, the lower range and high, these are very wide numbers. So I'm going to want to do more research as it falls more, comes more into my wheelhouse. And guess what? It probably will at some point, but it could be a buy at 140. If the fundamentals get a ton better and the stock price falls, it can meet somewhere in the middle. But remember, as you've seen from recent history, it is easier for the stock to fall than it is for the stock to rise and fundamentals get better. If you like this video and my thought process, please check out our next video where the coming recession could be the opportunity of a lifetime.